Hey everyone, John Henry here, Slingshot Futures Trading Group, SSFTG. Welcome to the video. In this one, we're going to be going over one of my favorite two-candle pattern setups, and that's the twin reversal. Now, you may have heard me talk about the twin reversal in previous videos or in previous live sessions, but it's been a little while since we've gone over what a twin reversal is, and I've been starting to get that question, so I know it's about time that we did another video on it. When we're looking at twin reversals, effectively the idea of a twin reversal is a total rejection. So let's say, as an example, you've got a previous swing high, and the market is working its way up to that area. When we get to that zone, a twin rejection would be, in this case, a bull bar going up, and then with equal size or very close, the bears crash right back down again. And one of the important factors here is that it is failing back below the point of interest, in this case, the swing high. So it closed above it and then immediately closed back below it. If you were to combine those candles together, it's effectively just a giant wick on top of the candle, and again, the idea is failure. Context is everything, of course, but it's a really good clue when something is going on. Now, when you're looking through the chart, you're going to find twin reversals all over the place. Is this one? Right? Well, how about this one? Or maybe these two together? Or how about, this one and this one? Do those count? So a twin reversal, again, it's all about location. I want to see the market attempting to break out. In this case, we have a direction that's obvious. It's pretty down-weighted. So when the market's coming down to the lows, I want to see the market breaking out and continuing. So when we go down and we look at this low, we can see that from a twin reversal perspective, the market closed outside of that low and then immediately failed back up in. That is a sign that something is wrong. If you were to add these two candles together, right? If you were to look at those two candles and clump them together, you've got the open here, you've got the close, which is here, right? So that's the body of the candle between this candle and this candle. You've got the wick that goes up to the high and all the way down to the bottom. Yes, it is a bear body, but that's a very bullish bear body. That's the idea of a twin reversal. So if I start seeing something like that, I know something's not right. That's not what should have happened. Now, we can use this to our advantage as well, not just as a heads up when something's wrong. One of my favorite ways to use it in our advantage is waiting for a trend to establish itself like this. It's a very nice downward trend. And wait for one of these swing highs that's going with the trend to create that type of scenario. Remember, we're looking for a failure. So if we go across this with the understanding that the market is moving lower and we look at the previous major swing highs, the market closes above, immediately fails back in, that's a twin reversal, and it rolls all the way back down again. Now you can see I did come back to it later, and there's a multitude of different twin reversals, but that's the idea. Now, there will be times where you will also hear me say, oh, it's like a twin reversal with a two-candle gap or something like that. What I'm referencing is a move up and a move down that had a little bit of a pause in the middle. Think of it just kind of from a common sense standpoint. You've had a big rally up, the market pauses for a little bit, and then a big drop back to the downside, right? It's still effectively a twin reversal, it just didn't do anything in the middle. So this would be a three-candle gap because it just hung out for three candles. That's all that means. So when I'm looking at these types of moves, when you're looking for these types of failures, as an example, this and this could be a twin reversal, right? They moved up and down just as aggressively. It just had 1, 2, 3, 4, 5, 6, 7 candle gap in the middle. That's the only difference. Now, these are a lot more difficult to read, but generally speaking, once you understand how they operate and how they work, and you kind of play around with them for a little while, you'll start seeing them all over the place. And very frequently, especially around swing highs and lows, when traders are trying to get the breakout and then it fails and goes back against them where they should have been selling at a better price. Over here where the market starts cracking lower, fails. They shouldn't have been selling down here. They should have been selling the retrace, and that's where it ended up going. These twin reversals can give you a big heads up in the overall directionality. Here's another one. Another twin reversal from the top to the bottom with a lot of candle gaps in the middle. But they can also give you a heads up as well as a potential entry direction as to where the market may want to go or where it just failed to try to go. Hopefully that helps you out in terms of what I'm talking about with a twin reversal. It's one of my absolute favorite two-candle patterns. It doesn't set up super frequently on a 5-minute chart. You might have a couple of them per day, but remember, location, 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 And of course, a little bit of context makes a big difference when you're talking about these twin reversals. As per the usual, if you have any questions, drop them in the comments below, or if you have a more detailed question, shoot me an email, jhb@ssftg.com. Until the next one, we'll talk to y'all then. Thanks.